Good morning, everyone. It is 6 a.m., half an hour before the market's going to open on Thursday, July 18th. Let's take a look at our futures. Remember, yesterday we had a big down day. So normally our reaction after a huge move is to move sideways. So unless we see something huge and amazing, we're not going to get too excited. The S&P 500 is up 28, 29. Yeah, about 30 basis points, random, up a random amount, so that's not too surprising. The Nasdaq is up 70 basis points. That is a non-random, so it is up, and Dow Jones is down about 20 basis points. So random, random, non-random, but we need to take this in context, right? Being up 0.7%, Nasdaq was down almost 3% yesterday. The S&P was down almost 1.5% yesterday. So for us to recover 0.7, that's not super exciting. Even though it's non-random, it's just not that exciting. So let's take a look on a daily chart and just to take that in context. If I look at my SPY, we gapped down and then traded below the EMA 8. And as we open today, we're right at the EMA 8. So we are opening right at resistance. So unless this market trades significantly higher, it would have to go at least above the high of yesterday, which is a little bit above that 560 level. Then we're not going to get too excited about the market going up. That 560 level, which we were looking at as a bottom range for us to chop sideways, is going to act as a resistance. So one of two things is, well, I guess one of three things is going to happen, but the two are more likely. The first is that we just trade back up to 560 and kind of chop around for the rest of this week because we do have very important options expirations coming up on Friday. The second is we might trade back into this range and chop around between the 560 and 560 like we originally thought. Now, we could continue to move down towards the EMA 20. That wouldn't be too unusual. We could trade up to the EMA 8 and then just come right back down into that EMA 20. But normally, when you have a big move, you have a gap and a move, we're going to consolidate for a couple days. So let's see, like this gap and did move higher after the gap. Then we just chopped sideways for 2 days before we continued. Gap, well, two gaps, and then moving sideways. Gap, move sideways. So let's see if we could find one to the downside. Probably going to be kind of hard because it's been a little while. This one, gap and move, and then undo the move, but not the gap. Gap, this one started to move back up. This one is not the is against the case that we were making, but it didn't move that much on the first day, and then it recovered on the second day. All it did was break even to where we were before, and then it went back down again. So it's not completely anti-example, the example I'm trying to find. Let's see if we can find one more. Or gap, move, and then just a tiny bit more down the next day. So that's mostly sideways. And then the next day, right back up. So that is a sideways movement for 2 days. So we have this gap down, and it is normal for us to recover some or even up to the high, and then just bounce for a second day, which would take us to the weekend, and then resume a direction next week. That's completely normal. Actually, nearly every example, if not every example that I just showed you, was exactly that. So again, we're not going to get too excited about a movement upwards. We're not going to say that it's a bounce and this is over and it's safe to move in. We're not going to say on SMH that, hey, we gap down and look, we're undoing 50% of it on the open and get too excited because it is normal for us to recover and get to the high of the previous day, maybe a little bit higher, challenge that EMA 20 and chop sideways. So don't go in and try to bottom feed today is basically what I'm trying to say. We didn't quite get to the MA 50. Could we bounce from here? Yeah, sure. There's a little bit of a flat region right here there is a little bit of support right at exactly where we are, and we could bounce and go up, but it's too early. If you get overly excited and say, hey, I'm going to get in on this, it's a bounce, and then we just hit that EMA 20 and come right back down, well, you're kind of in trouble. Why not wait until we get above that EMA 20, the EMA 8, and you still have at least this much room to make money? So this is a safe, easy money. This is risky, almost gambling money. So you could just take that safe, easy money if you're a little bit more patient instead of gambling with a movement, with the initial movement. That's the main point here is that the initial movement is a gamble. The rest of the movement might be okay, but just remove the gamble part of it and just wait a little bit and you'll still make plenty of money. So don't get too excited about this bounce in the QQQ. And realistically, if we look at it, it's not even bouncing back to the EMA 20 yet. So it could very easily this morning trade up to that EMA 20 level, which will act as a resistance, and then start heading right back down. And again, just a gap and a move, it's normal for us to chop sideways for a couple of days. So far, nothing this morning is surprising. Nothing this morning changes our opinion or the direction that it looks like this market is going. And QQQ still does look like it's going to come down and touch that MA 50, or at least get very close to it. The S&P, right now we're still talking about the EMA 20, not the MA 50 yet. Although the MA 50 is still very possible. So let's take a look at, I guess we already looked at that. Let's look at the intraday and see how that plays out. So we closed right here, and overnight we retraced 2 levels. And remember, 2 levels is random. So far, a random amount, we're going right up into the 559, which we drew a a purple line right here. And above that, we'll have the 560. We've got 560.2. See why. Okay, I see why, but we can move this down to 560. So we need to break that 560 level before we get any sort of confidence that we could move higher. But even if we do, we're not even starting to fill this gap yet. It still has 2 regions to traverse. Well, 3. 1, 2, 3. Yeah, 3 regions to traverse for us to get to break even. So that's not looking too likely. I wouldn't get too excited about any sort of upward movement today. Now, if we get upward movement today and then upward movement the day after, where does that put us? Well, that puts us basically even with that 565 level. And that's not going to be too surprising either, because our expectation originally before this big down day was chop sideways below 565. And I was very comfortable calling that 565 level even when we were only 14 cents away from it. So that 560 level is a very strong resistance for this week before options expiration. After that, it might be a completely different story. So everything that we were looking at before yesterday's big move is still in play. Options expiration is still a very important data point for us, and nothing in this world has really changed other than the markets being reverted a little bit. If we look at SMH, some people are getting excited that Taiwan Semiconductor put out good earnings. Well, let's take a look at Taiwan Semiconductor. Okay, so in the pre-market, it looks like Taiwan Semiconductor is going to open at, excuse me, the previous day's high. Excuse me. So that's not exciting. That doesn't look like a huge earnings reaction. Normally, a huge earnings reaction is a huge movement upwards, significant, not undoing the previous day's range. That's not a huge reaction. Let me see if we can see, like, the previous earnings reaction was here we were and we gapped down and kept on moving a little bit. And then this is a big earnings reaction, a huge gap up and a continued movement upwards. This one is a gap up. That is a earnings reaction. It's not undo yesterday's move. So I don't think this Taiwan Semiconductor earnings is going to have much of an effect on SMH. And basically, the earnings reaction is basically already this. It's just moving halfway of what we lost on the bar of yesterday, not even including the gap, just halfway of the bar. So I don't think earnings is going to save semiconductors in this instance. Semiconductors went down because of geopolitical risks, because of risks of China, because the US continues to not want technology to fall into China's hands. And they're putting a lot of restrictions on business, on what semiconductors, at least American companies, are allowed to sell to China or even to other countries because they have a tendency to still end up in China. So I might sell to Japan, and then Japan sells to China, right? They're trying to cut off those routes to China. And that means hampering business. It means less sales for these companies. That's why we had this big reaction. It's not because of earnings, bad earnings, good earnings. Earnings will have an effect for a day, 3 days, a week, 2 weeks. We're talking about 2 to 4 years of of future business being affected because of US policy. So earnings isn't going to undo that. So don't get excited, don't bottom feed, don't try to go into semiconductors unless we start getting above that EMA 20 or MA8 and EMA 8. And I really don't see that happening this week, Thursday, Friday. Next week, it would still be very difficult. And as long as we have that, then we don't have many of the large cap stocks helping the QQQ go up, which means stalling out, at the very least, chopping sideways. And if not, coming down and touching that MA50. We could chop sideways until that MA50 rises and touches it. So right now we don't know. We don't know. All we know is that most likely we are going to touch that MA50. Are we going to come down and touch it, or is this going to rise and touch it? Well, over the next 2 days, it's a little bit more likely we'll chop sideways, which will give this a little bit more chance to come up. And then next week we'll see. That will be more dependent on the picture that we get after options expiration. So again, the big data point we're waiting for is where do dealers and, or not dealers, because dealers have to take the opposite side, but where do institutions start putting their money after the options expiration this week? Let's take a look at our momentum. And I don't know if we'll get a good idea of our sectors, but we can at least look at our 90-day highs and 90-day lows. 13 lows yesterday, 296 highs yesterday. Or so this is a little bit updated from what we saw on at the close, because this data there's a lag. So we were looking at about 300 and something yesterday and still in the tens on the lows. So that's not, the picture hasn't changed that much. We were at 640 something. We came down to roughly 300. Normally that will continue to move downwards, at least into about 1 to 200. And then we will want to see an extreme happen in these lows before we call a bounce. So right now, this is indicating that we might have a little bit more to drop. And then if we don't start seeing huge numbers in the 90-day lows, then we're just chopping sideways again. So we don't know yet how that's going to play out. But again, we only have today and tomorrow before the end of the week. So again, even this, we're going to wait for options expiration. The moral of the story is, let's not make any huge moves before options expiration. We're just going to wait and see what this market does and make sure that we're positioned well. Either we're neutral, completely neutral at this point, or we're in all cash. But the time that is getting closer and closer, namely mostly Monday, well, where we can really start putting capital to work with strong confidence. There might be one or two places where we can find some high conviction trades. And if I can find them, then I'm going to put them out in my portfolios. But for the most part, I'm going to be waiting for Monday to deploy capital. I'm going to be looking all weekend at the options data and then make a decision about how to deploy capital on Monday morning. So that's what I suggest because that the options expiration will trump anything that we can see right now. The options expiration gives us a very clear picture of how institutions are positioning themselves. Whereas right now, we would just be guessing or saying it's likely that they're going to position themselves this way. After Friday, we know they're positioning themselves a certain way, or at least the beginnings of a position, because they don't necessarily just suddenly, after one day, just start putting out their entire position. At least we can see the direction they're leaning. We might need until Tuesday because all the options come off and they're putting on new options. Yeah, because they're not going to just let them expire and sit on cash, but they may need Monday to deploy even more cash for us to see more of a direction. So we might need until Tuesday, but at least at the end of day on Friday, we'll get a reasonable idea. So let's let's just wait for it. Let's take a quick look at these bonds or probability of rate cuts, see if any sanity has come back into the markets, 4.7%. So like I said, it's probably very close to zero. 4.7 is close enough, I guess. September, hopefully we're not still at 100%. We are not. Okay, so we're at 98.1% likely that we're going to get a rate cut in September. That's just not happening. I think it was Waller. Let's take a Waller spoke yesterday. Yeah, Waller. Waller was in the news saying that he felt that, oh, we're getting closer to a rate cut and the data is suggesting a rate cut and he felt like that we're going to get a rate cut very soon, which sounds like there's going to be a rate cut and it sounds like people get excited that we're going to cut in September. But then he goes and says we're going to get a rate cut soon, but we still need several months of data in order to confirm that before we make a move, before we're comfortable that inflation is moving in the right direction. Okay, well, what's several months of data? It's not August, September. That's got to be at least longer than that in order for us to call it several months. So September is not imminent. And then Trump warned Powell, it's like, don't you cut rates before November because then it would be very political. For anything to be cut before, but cut this September would be very, very political. And we only have, and then we will have November. So do we get a cut in September? It's very low. I've been saying about 25%. It shouldn't be, well, which isn't super low, but it's not a trade I would want to make. If you told me I have a 25% chance of winning on this trade, I would say I better have at least a 5 to 10 to 1 reward risk ratio before I'm even interested in looking at it. So this trade, or sorry, this probability will start collapsing at some point, just like this one used to be 70, 80% for the rate cut, and now it's at 4.7%. Let's see, we only have 1 month's projection. So let's see about three months, April. Let's look at March, April on the TLT. Okay, March peak, April second, another peak, and then we went way down here. Okay. And then we start to price in not just the next month, nor the next rate cut, but the second rate cut ahead as well. So then we had a little bit of a recovery over here. So that's what we would expect. A movement downwards, a strong movement downwards, and then potentially we start looking at November. November is a lot more likely, November, December, a lot more likely. So then we would start to move upwards. But this does need to come down quite a bit before it can move back upwards. All right, so let's take a look at what we might expect for today's trading action. And I would just say chop. I'm not going to get excited if we move 2 regions up or 2 regions down. So 5.5 to about 562 on the S&P 500. If we're not going to get excited about one direction or the other unless we break those levels. 555.5 is right about there. And you can see, well, if we moved it there, it doesn't look like we moved that much when we're zoomed out like this. And if I go to 562, okay, same thing. It just doesn't look like we moved that much. That would be a sideways bar. So if we move more than that, then we can maybe start saying, okay, that is a movement, that we're not chopping sideways. Just be very careful. Don't get over exuberant. Don't get too excited if you start seeing, for example, semiconductors moving, because unless it breaks that EMA 20 or EMA 8, then it's not a real move. It's just a reaction to what happened yesterday. Okay. We'll end it there. We have a good expectation of what is coming up. I think you're going to see people get excited about a little bounce in SMH. So you might see some money coming into SMH, and then the picture will look a little bit more rosy again. And then retail traders might go into it, and then they are in for a smackdown by the institutions at options expiration. We'll see. Option expiration, we say, hey, well, let's give them a couple days to recover and feel really good and feel like we're resuming our movement upwards. But when the institutions come in and redeploy their capital, if they don't put it back into SMH, or they start buying puts on any of the semiconductor stocks, then we've got ourselves a strong movement downwards. And that would be correlated with a movement towards the MA50 in the SPY. I'm not saying that's going to happen. I'm just saying that it's a possibility, and we don't want to be caught on the wrong side of that possibility, because the downside risk is far greater than the upside risk. So you don't want to trade in the direction of the upside unless you have a really, really, really good reward to risk ratio and you have a limited potential for loss. You have a defined loss. Not like just short the stock or not just long the stock. You don't have a defined risk there. You would have to do something where I know that if I'm wrong, and if I'm super wrong, the maximum amount I'm going to lose is this. And I'm okay with that maximum amount, not my stop loss amount, with the maximum amount. That's the only way you would want to go into those trades. And when you calculate the reward to risk ratio, you're going to calculate it based on that maximum risk. So you better have at least a 1.5 to 1 reward to risk ratio based on the maximum risk. That's going to be pretty difficult to do, because anything that you go in, for example, if I say, hey, well, I want to go to NVIDIA, it looks like we got pretty close to that MA50 and we want to go. And I go and I look at it, NVIDIA, and I go and look at it, NVIDIA, just say call. I want to give myself, say, at least 40 days, 50 days till expiration. So that means I would be going out to probably September. And I want to buy even an at the money call. I'm talking $1,000. So for one, am I okay with losing $1,000? Well, if I have a 1-to-1 reward risk ratio, that means this thing has to double in order for me to make money. And that means that I've got to go at least to 132, 135. And do we believe that Nvidia is going to go all the way back up here? And it's like, yeah, that's pretty difficult. The only thing that Nvidia has to do is sit here and do nothing. If I buy an at the money call, all it has to do is chop sideways. It doesn't even have to go down, and I can lose the maximum amount if I let enough time pass by. But yeah, it's got to go at least up to, well, if I letting time go by, it's got to go up to 135 just for me to break even. And then it's got to go up to 145 for me to double. And that's by September. That's out to here, the next earnings. So it's going to be very hard to find decent reward risk ratio trades if I'm allowing for the entire amount to go against me. And basically, why go through all that time and effort and energy looking for these trades when I can just wait 2 days and dozens of opportunities are just going to be served to me? So my suggestion is just avoid it. Just wait 2 days, be patient, and we'll just wait and see how everything plays out. All right, we are only 4 minutes away from the open, so we'll end it right there. Have a wonderful day, and I will see you in the post market.